Welcome back, investors, to Ticker Time News. I'm Adam, and after taking a step in the right direction last quarter when Duck Creek Technologies, ticker symbol DCT, flew higher on a beat and raise report, they now find their wings clipped following the release of a decent Q2 report overshadowed by downbeat Q3 guidance. The software as a service developer of property and casualty insurance software continues to encounter choppy waters. Shares have fallen to half their August 2020 IPO opening price of $40 a share. So, what's kept Duck Creek grounded? Well, it's a challenging combination of a somewhat pricey multiple and, bigger yet, slowing growth. Now, don't let your portfolio's growth slow down either. Come beat the market with us by clicking the first link in the description. I'll see you there. Now, there was a silver lining to Duck Creek's story, and that was after multiple quarters filled with less than stellar results, investors reset their expectations. But following Duck Creek's bullish outlook last quarter, perhaps it was finally time for Duck Creek to reverse a long downward trend. But then we get to today, with the company guiding Q3 revenues below estimates. So it appears that investors will need to lower the bar once again. And this is the problem with young growth stocks. Now, I'm not saying you can't change your investment thesis from time to time, because you absolutely must keep your investment thesis fluid as market conditions change and companies either hit roadblocks or they accelerate. But when you have to continually lower your expectations quarter over quarter over quarter, that's when you need to make the tough calls and weigh your opportunity cost. Okay, back to Duck Creek here. Let's begin with the rough spots from Q2. The company expects Q3 revenue of $71 to $73 million, or just 6% growth year over year at the midpoint. This would mark Duck Creek's slowest quarterly growth rate since becoming a public company. The weakest quarter thus far saw an 18.6% growth year over year. Additionally, as revenues jumped 22% year over year in Q2 to $76.42 million, Duck Creek's Q3 guidance could also translate to its first quarter over quarter decline. Now, the light growth expected from Q3 stems from delayed timing of certain bookings. I know it gets a little complicated here. I'll try to keep it as simple as possible. Duck Creek reiterated that it serves a low volume, high average deal value market. This also means that small changes in buying behavior can drive significant near-term swings in bookings and SaaS, or software as a service, annual recurring revenue, or ARR. A similar scenario actually played out in Q2 as well. New business signed during the quarter missed Duck Creek's expectations due to delays in signing several critical deals, leading to ARR, or annual recurring revenue growth, of just 28% year over year to $151.4 million, a deceleration from the 40+% last quarter. Duck Creek said that heightened uncertainty due to the current inflationary environment and other macroeconomic factors are lengthening its sales cycles with some of its larger customers. However, Duck Creek still inked many key contracts during Q2, including Philadelphia Insurance Companies, a California-based startup InsurTech, and a leading Tier 2 insurer, EMC. Now, other notable highlights included growing adjusted EPS to 4 cents a share from 1 cent a share in the same quarter a year ago, topping estimates in the process, as well as still raising fiscal year 22 revenue guidance. Duck Creek expects fiscal year 22 revenue of $301 to $305 million, and that's up from the prior guidance of just $298 to $304 million, and above analyst estimates at the midpoint. However, investors aren't honing in on the mostly upside fiscal year 22 revenue guidance, especially since it still represents a slowdown in growth from fiscal year 21. But perhaps with the recent sell-off, Duck Creek is finally bottoming out. The company is heading into favorable tailwinds as the financial sector adopts more digital platforms to better compete with the boom in fintech alternatives. So, Duck Creek is a name to keep on your radar, as it's positioned to benefit once the inflationary induced uncertainty begins to ease. So, what do you think about Duck Creek Technologies? Let me know in the comments below, as your comments help us all to better understand Duck Creek Technologies. Do me a favor, if you can, smash that like button, share this video, and I want you to beat the market with us by clicking the first link in the description. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching, and I'll see you in the next video.